Okay, dear students, we're going to delve into the great debate of active management versus passive management. Index funds, as you might recall from our discussion of the fees in presentation 2, are passively managed. That means these mutual funds buy and hold a portfolio of stocks or bonds or whatever, equivalent to those of a specific market index, a list of stocks or bonds. There's no active management performed. They don't knock on the doors of Coca-Cola and Pepsi and Monster and decide which ones to invest in. They simply look at a list, and there are many of these things, and we're going to delve into these in more detail in Chapter 3 and learn about just a few of them. There are literally hundreds, thousands. You might have heard of the Standard & Poor's 500. We've already been mentioning it. The Dow Jones Industrial Average, the Russell 2000. Wait until Chapter 3. Why? Well, they can offer much lower annual operating expenses, as we saw, much lower, although be careful, your insurance company might try to sneak those into your 401k. And many actively managed mutual funds don't beat the market. So why bother? Just be happy with the market's return. Because of the annual fee, an index fund cannot actually match the market's performance, but it should come very close, as we saw in the second presentation, providing the annual fee is not excessive. Whereas an actively managed fund could substantially outperform or underperform the market index. So where did the rationale come from? Well, it started in the late 1960s, early 1970s. It came from research done in the early 1970s that statistically showed that many of the actively managed funds simply did not beat the market. A monkey throwing darts at a dartboard often did better than the mutual fund managers. But that's throwing the baby out with the bathwater, so to speak. Many actively managed funds do beat their respective indices over statistically significant periods of time. And we're going to discuss fund families in our next presentation. My advice is look for a fund family where most all the funds have consistently beaten their respective indexes over decades. And what's happened in the past is some indexes have become victims of their own success. That happened, as we're going to see, in Japan, and it happened in the United States at the end of the 1990s. And personally, I think it's happening right now, where a few stocks are the tail wagging the dog. Here are just some of the indices you're going to come across. The Standard & Poor's 500, the Dow Jones Industrial Average, the U.S. Total Stock Market Index, used to be called the Wilshire 5000, the Wilshire 4500, the NASDAQ, the Global, World, and EFA. And there are just thousands of these things. I can't believe it, but that's what S&P says on their website, Standard & Poor's, because they're the ones, spglobal.com, who are the sponsor for the S&P 500 index, which is very popular. And we saw both Vanguard and Fidelity and many other mutual funds companies have index funds that mirror these indices. You are going to hear all kinds of wonderful, superlative, fail-safe platitudes given to index funds. And you're going to hear people say how horrible actively managed funds are. Well, remember, there's thousands of the darn things out there. So some are good and some are not so good. And if you ever look at a mutual fund company and say, well, look at these guys. They've done pretty well. You will be accused of shilling for them. You'll be accused of being a fanboy or girl. I think it's ridiculous, but hey, people don't like to be confronted with facts that counteract their worldview. So you will hear people say, you just should put money in the S&P 500. Well, there is a bonus assignment in Chapter 2 where you're going to see the top 10 companies in the Standard & Poor's 500 and see what contribution they make to a list of 500 different stocks. I think it's a bit of an eye-opener. And I think most people who do invest in the S&P 500 really do not understand what's underneath the hood. They just hear that they have 500 different companies, and they do. In what percentages? Slide number 60, ETFs. We discussed exchange-traded funds. They're open-ended mutual funds that trade like a stock, like a closed-end mutual fund. And there's no limited number of shares that they're open-ended, but they are bought and sold on the open market. And we made mention that Jack Bogle, who started Vanguard, was really upset when these things came out because he thought they were just being used as trading vehicles. Well, there's some of that, yes. But there's a lot of people who invest in their ETFs and hold them for the long term. They're very popular because of the low fees, and you can buy them and sell them throughout the day. Now, the original ETFs were all index funds, passively managed. And here's where some confusion sets in, because people believe automatically that an ETF is an index fund. It just buys and sells the companies or the bonds in the list that it is mirroring. But that's not true anymore. There are many actively managed ETFs, and they have a bit of a leg up on open-end mutual funds because of the ability to be a little bit more tax efficient. But in my humble opinion, taxes should not be the tail that wags the dog. I love it when I pay taxes because that means I made money. Right? I had a friend once who was complaining bitterly about having to pay taxes, and I said, I have a way that you don't have to pay any taxes on your investments. He said, how do you do it? I said, give them to me. I'll pay the taxes. And the best thing about ETFs is they have really cool names like Spider and Diamond and Cube, and that's really important, don't you think? Anyway, you might want to research an ETF instead of open-ended mutual funds for the Chapter 2 assignment. Oh, by the way, 4 out of the 5 of the mutual funds that you're going to look up when you research the Thrift Savings Plan, the TSP, which is the federal government's 401k plan for federal employees, are index funds. One is actively managed, but it's managed in a passive way. It's just a bunch of bonds. Slide number 61. Now, this graph might not make a whole lot of sense to you because you really don't know what price to earnings ratio is, PE, price to earnings. But we're going to come back to it later, so you don't worry about it if you don't understand it. No big deal. We'll come back to this later after we've gone through stocks. Sometimes indices become skewed toward a particular sector of the economy or region of the world. In the case of the Japanese stock market in 1980s, it went in 4 directions: up, way, way up, and skyrocketed. Many of you weren't around, but there was a song, "I'm Turning Japanese," and because of many things that were being bought from the by the United Staters, made by the Japanese. So everyone thought the Japanese were going to take over the world. Now everybody thinks the Chinese are going to take over the world. Well, the stock market in Japan was just wildly overvalued. And at the end of the 1980s, you looked at the MSCI EFA. What is that? Well, that's one of the very famous indices that was designed, stands for Morgan Stanley Capital International, Europe, Australia, and the Far East. Don't worry about it. We'll come back to it in Chapter 3. But it was meant to show how stocks were doing outside the United States, the developed world outside the United States, Canada, South Africa, Europe, of course, Western Europe, Australia, Japan, Singapore, Hong Kong. Yeah, those were the countries. What else? I'm missing one, I think. But at that time, the index was fully 60%, 59.8% made up of Japanese stocks with a very high price to earnings ratio. Now, what is the price to earnings ratio? Relax. The higher it is, the more riskier the stock or investment. And in this case, Japanese stocks were very, very risky, very risky. And people just thought they were going to go to the moon, and they almost did, but no, then they fell and crashed and did not come back to where they were just about a year or so ago. I forget. Of course, these indices are imperfect, as we'll discuss, because some of the stocks are gone. Some of the companies are gone. They've been replaced with other companies, whatever. But everything else, Canada, Western Europe, South Africa, Australia, Singapore, Hong Kong, I'm forgetting one, was 40% of the index with a very reasonable price to earnings ratio of 13. The Japanese stock market literally imploded. But you thought you were getting a wildly, broadly based international index. You weren't. The same thing happened 10 years later with the Standard & Poor's 500. In the dot-com era, the bubble, the internet bubble, some companies that would never, ever make a dime of earnings were selling at nosebleed evaluations. You might have heard of AOL, America Online. Well, they actually were making money for a while there. Or drcoop.com or theglobe.com or the street or CMGI, mp3.com. These were all companies, folks, and they're all gone. I mean, AOL is a shell of what it was. But they were selling for outrageous amounts of money. And everything else in the standard, so they made up, the information technology field sector of the United States economy made up 1/3. And we're talking about the United States, folks. Everything else, energy, consumer products, real estate companies, healthcare, everything else made up 2/3 of the index. The tech sector as a whole had a PE, a very high, 59.2. We're talking nosebleed here. And so people just thought the sky's the limit. There were books. There was one book, Dow 36,000, which I knew at the time that eventually Dow was going to hit 36,000, but it wasn't going to be in a couple of years like this guy was talking about, and it did hit eventually 36,000. Everything else was at a kind of high PE of 19, but nowhere near as high as the tech sector. And then what happened? Well, March of 2000 was the peak of the bubble. And for 2.5 years, until October 2002, the market just kept falling and falling and falling. The Standard & Poor's 500 lost about 50%, 500 of the largest companies based in the United States. The information technology sector of the economy fell 80%. The internet sector fell 94 or 96%. Let's say 95. It was either 94 or 96. Right. So indices are not perfect. Nothing is perfect. No thing that we humans have ever made is perfect. So don't let anybody tell you that you should only ever invest in an index fund, because there are times when index funds are skewed out of proportion. And I think that time is one of them now, is one of those times. And what you're going to do as a bonus assignment, please take a look at the bonus assignment, which asks you to find the percentages of the top 10 companies in the Standard & Poor's 500 and add them up and see how much the top 10 companies make out of a list of 500 companies. Now, it's a little tricky. One company is actually there twice, so you have to actually look at the top 11 to get the top 10, figure that one out. Cool? And then be careful when you talk to your friends and family or whoever you talk to that only believes that the only thing you should ever invest in is the Standard & Poor's 500. All right. Remember, all investments have advantages, all investments have disadvantages, and as rising investment gurus, your job is to keep your eyes open. I'm not saying you should never invest in the Standard & Poor's 500 fund. That's not what I'm saying. I'm saying keep your eyes open and look and understand thoroughly what you're investing in. Okay, enough proselytizing. Thank you so much, as always, for being in our class. And be awesome, dear students. Bring honor and glory to Southwestern Community College, your family, your friends, your colleagues, and of course, yourself.